This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Recipe for a turnaround: how McDonald's new CEO plans to shake off years of sliding sales and traffic.
New role: Dow component Cisco does something it hasn't done in nearly 2 decades.
And Weekend with Warren: what the Oracle of Omaha said about stocks, bonds, and the topic that put Buffett on the defensive. All that and more tonight on Nightly Business Report for Monday, May 4th.
Good evening, everyone, and welcome. Big changes are coming to two very, very large companies. McDonald's new CEO unveiled a massive global turnaround plan, one that he says will revive the business and one that shareholders hope will revive the stock price. At fellow Dow component Cisco, longtime CEO John Chambers is stepping down after 20 years in the top job. Cisco veteran Chuck Robbins is in, bringing to an end one of Silicon Valley's longest CEO runs. Now, McDonald's investors weren't impressed. They sent shares lower today. Cisco managed to rise fractionally, as you see there. We've got two reports for you tonight. Josh Lipton with more on Cisco's new leadership. But first, Courtney Reagan looks at the new strategy for the world's biggest burger chain.
The Golden Arches have been a little tarnished in recent quarters. It's going to take a lot to turn around the world's largest restaurant chain, but today, McDonald's CEO Steve Easterbrook is detailing at least the initial strategy, 2 months after taking over the top job.
The reality is our recent performance has been poor. The numbers don't lie, which is why, as we celebrate 60 years of McDonald's, I will not shy away from the urgent need to reset this business.
McDonald's will sell 3,500 restaurants to franchisees, taking global franchisee ownership to 90% from 81%, which Easterbrook says will generate more stable and predictable revenue and cash flow streams. The fast food chain will cut layers and bureaucracy, finding $300 million in annual cost savings by the end of 2017. McDonald's will reorganize its business units into 4 segments based more on growth opportunities than geography. Further, McDonald's will return $8 to $9 billion to shareholders this year. Less defined but still stated missions include improving food quality and brand perception, bringing the customer voice back into the business, and being bolder and faster with innovation. Easterbrook said the company is amping up consumer choices, from how you order to what you order. McDonald's is testing new menu items like taste-crafted sandwiches, where customers can choose beef or chicken, choosing between 3 roll types and 4 different flavors.
From here, we would expect to see sales improve gently through the year. Second half recovery in sales, perhaps not a powerful one, but we see this story being an improvement story in the second half, and that continuing into 17 as they get some of this restructuring done over the next couple years.
Competition in the fast food and fast casual dining space is as intense as it's ever been. Ultimately, analysts say winning the consumer will come down to the perfect combination of taste, value, and experience. For Nightly Business Report, I'm Courtney Reagan.
When we talked about changing the world back in 1993, changing the way the world works, lives, learns, and plays, it's now happening on steroids.
It is the end of an era in Silicon Valley. Cisco announced that John Chambers will be stepping down from his role as CEO. Chambers has held that position since 1995. Analysts who cover the company praise him for the passion that he brought to the tech bellwether, which makes equipment that directs data traffic across the internet. Chambers will assume the role of executive chairman in late July.
Am I doing what I imagined I would be doing at this stage in my life? Absolutely not.
His replacement is Chuck Robbins, who has worked in several management roles at the company. Most recently, he was the senior vice president of worldwide operations. In a conference call, Robbins said he was humbled and honored by the appointment. Robbins does have a challenging task ahead of him, though. RBC says that Cisco is facing a range of competitive threats on a number of fronts: Juniper in networking, Arista in switching, and Palo Alto Networks in security, to name just a few. They say Cisco needed an insider like Robbins, who understands the company's culture and can help steer the networking giant through this challenging period with a steady hand. Analysts also mentioned another hope with this change in the C-suite, greater capital return.
The company does about $1 billion a quarter in buybacks, another $1 billion a quarter in dividends. I think most investors think that can go to $3 to $4 billion a quarter, from 1 to 2 in cash return.
Cisco stock is up nearly 30% in the past 12 months. Can Robbins keep the momentum going? Only time will tell, but investors could have a better sense when the Silicon Valley company reports earnings next week. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
With John Chambers staying on as executive chairman, that could present a unique set of challenges to Cisco's new CEO. We'll have that story for you a little later in the broadcast.
On Wall Street today, the S&P 500 closed just shy of a new record. Helping sentiment, factory orders, they rose more than 2% in March, the largest increase in 8 months. The Dow Jones Industrial Average was up 46 points to close at 18,070. The Nasdaq rose 11 points, and the S&P 500 was higher by 6.
Warren Buffett's shareholder meeting this past weekend set a new attendance record, and while the event was full of the usual fun and games, the billionaire investor also fielded more serious questions about the markets and about some of his most recognizable investments. Becky Quick spoke to the world's most famous investor and has more from Omaha.
The most frequently asked question of Warren Buffett: where's the stock market? Where is it headed from here? It's something that he has called occasionally over the last 60 years in his career, but right now he says that is much more difficult to do, and that's because it all depends on what happens to interest rates.
The market against normal interest rates is on the high side of valuation, not dangerously high, but on the high side of valuation. On the other hand, if these interest rates were to continue for 10 years, stocks would be extremely cheap now. And the one thing you can say is stocks are cheaper than bonds.
One of the companies that you told me you've been buying more stock in is IBM. You told me that on Saturday, that in the first quarter you bought more shares. We will see that coming out in SEC filings soon. What do you see happening over the long haul?
Well, I think 10 years from now that they'll be earning a fair amount more money than they are now, and I think they'll have a fair amount fewer shares. So our percentage ownership will be up, and I think we'll make considerable money. I can always be wrong on any stock, but that's my best estimate. I felt that way when we started buying it a few years ago. I think they had 1,165 million or something like that shares out then. They have 985 million shares out now, so our interest has gone up by 15% or so without us laying out a dime in that respect.
The other issue that seemed to come up a lot was concerns about changing taste, consumer taste in the food industries that Berkshire owns major stakes in. Companies like Kraft, companies like Coca-Cola, people concerned about whether this food is good for them, and that's something that millennials in particular have been thinking about.
There's 1.9 billion 8-ounce servings of Coca-Cola products sold around the world today. And there will be more than 1.9 billion a year from now, and more than that 5 years from now, and more than that 10 years from now. And that's been true, and some people will like other things, and if they like broccoli and Brussels sprouts, God bless them, but don't invite me for dinner.
In all seriousness, Buffett does admit that consumers' tastes can change over time, but he says the companies he's involved with, like Coca-Cola and Kraft, are doing their best to make sure they stay ahead of those changing times, and he has full confidence in their ability to do just that. For Nightly Business Report, I'm Becky Quick from Omaha, Nebraska.
Buffett also said he would short the 30-year bond if he could, and has no regrets about picking IBM over Apple. Joe Tanius joins us now to discuss what Mr. Buffett had to say on stocks, bonds, and the market. Good to see you again, Joe.
Good to see you, Sue.
Let's start first of all with what he said about the bond market. He said he'd short the 30-year if he could. You agree with that play?
You know, I understand his positioning. What he's essentially saying is that interest rates right now are incredibly low, and odds are for a long-term investor that they're probably going to go up rather than go down. Of course, one of the ways that you want to take advantage of that is just having a short position in the bond market. So I agree with taking an underweight position there.
He also said, as you probably heard there, that if interest rates were normalized, stocks would be highly overvalued or overvalued at today's prices. If rates stay low, they look like a bargain to him. How do you see stocks?
I think, Buffett, again, is thinking about it the right way. You have to consider valuations within the context of where interest rates are. And of course, when interest rates stay incredibly low, it just becomes a more profitable environment for companies. Think about borrowing costs, think about inflation, think about rates in general. And broadly speaking, when interest rates are very low, it's a good thing for companies. And of course, if interest rates are much higher, it becomes more of a problem. So his perspective in saying that stocks today are not as expensive because interest rates are low, I think is dead on.
In the past, you've said that you don't think the Fed's going to move on rates until the latter part of the year. Do you still agree with that?
I do. I think the Fed's, they have a dual mandate, of course, and are focused on two things. One being the labor market and the other being inflation. I think we've seen a lot of signs that the labor market is healing. Things are clearly moving in the right direction. It's not perfect, but moving in the right direction. And inflation, in our view, is firming. I suspect that as the U.S. economy continues to heal, the Fed no longer needs to keep giving it medicine. And I suspect at some point later this year, probably in the back half of this year, you're going to see the Federal Reserve putting the U.S. economy back on a path towards normal, which means raising interest rates.
As you look at the U.S. market most particularly, what, if any, sector feels like the one that offers the best opportunity today for the next year to two?
As I look at the U.S. economy, clearly heading out of a rough patch, if you will, in the first quarter of this year, a lot of it due to weather, I think you're going to see a lot of pent-up demand coming into the second quarter and the back half of this year as the consumer finally goes out and starts to spend all of that money that they were essentially holding on to. Also, you've had this tailwind, if you will, from lower oil prices, which we haven't really seen materialize into spending. We've seen it turn into savings. I suspect in the back half of this year, we're going to see spending pick up, and I want to be focused on sectors that stand to benefit from increased spending on the consumer side. Think of cyclicals, think of consumer discretionaries, even consumer staples to an extent.
Joe, thank you as always. Joe Tanius with Bessemer Trust. Ty?
Still ahead, Sue. Got milk? What the country's biggest milk producer is doing to make the beverage relevant again. PIMCO's flagship Total Return Fund lost its title as the largest bond mutual fund to the Vanguard Group. According to April data released by both companies and as reported in the Wall Street Journal, Vanguard's Total Bond Market Index Fund had $117 billion in assets as of the end of last month. PIMCO's Total Return Fund, $110 billion.
As we reported a bit earlier in the broadcast, Cisco's John Chambers is stepping aside as CEO, but he's not going away. He will remain as chairman of the firm he ran for 20 years. His continued presence may soothe some investors, but as our Mary Thompson reports, it will also pose challenges for Chambers' successor, Chuck Robbins.
For 20 years, John Chambers served as chief evangelist and head architect of a firm whose stock climbed 1,400% under his watch. By stepping down as CEO and staying on as chairman, he can now provide important cover and counsel to his successor, Chuck Robbins.
There are all sorts of aspects of the job that he's going to have to learn, and the advantage is having a great teacher around.
Still, Chambers' continued presence at the firm could create problems, according to Professor Joe Bauer.
When the previous CEO stays on, it always makes it harder for the new CEO to make changes, particularly if the new CEO has in mind dramatic changes.
Cisco! Whoa! As executive chairman, Chambers will likely be in the office every day. And unless he checks his ego at the door, experts say he may resist changes Robbins needs to make at the company Chambers built. His presence might also be seen as a constant threat to Robbins. Professor Catherine Harrigan saying the board could easily turn to Chambers if Robbins stumbles.
There'll be non-executive meetings of the board where the chairman will stay, and they'll talk about the CEO. And if he feels like he wants to get back in, he could easily have the rest of the board, who is probably in awe of him anyhow, rubber stamp the idea that the current CEO should be shunted aside.
Former CEOs cast long shadows. Remember, Starbucks chairman Howard Schultz returned as CEO following a disappointing run for the coffee chain. And while he's no longer CEO, Oracle chairman Larry Ellison remains the face of the software firm he founded.
Executive coach Mark Nadler saying best practices dictate a former CEO should probably stay on as chairman for a year or less, then leave.
Nadler citing Steve Ballmer's resignation as Microsoft's chairman less than a year after stepping down as CEO as being exemplary. This gave successor Satya Nadella the freedom to plot a new and clear course for the software firm. Chambers' future, however, is less clear. Cisco says his term as chairman is indefinite, something that could definitely create problems for Robbins. For Nightly Business Report, I'm Mary Thompson.
Well, Comcast's earnings and revenue top estimates, and that's where we begin tonight's Market Focus. The company's broadband division logged its strongest revenue growth in more than 4 years. Comcast also announced it's going to spend another $2.5 billion buying back shares this year. Shares were up a fraction to $58.78, and Comcast is the parent of CNBC, which produces this program. Cablevision, meanwhile, said its video subscriber losses in the first quarter doubled from a year ago. Still, the cable operator managed to beat on the top and bottom lines. Shares up a nickel to $20.44. Sue?
Cognizant Technology Ties Solutions saw its profits rise as revenue increased in its financial services and its healthcare segments. After beating analysts' expectations, the firm upped its earnings and sales outlook for the full year. Shares popped 6% to $62.78. Strong ad sales helped AMC Networks post results that blew past estimates. Earnings were up almost 70% on the success of the TV network's original programming. Shares moved higher by almost 5% to $80.02.
Well, McDonald's, whom we talked about a few moments ago, isn't the only company in the food business trying to plot a turnaround. So is Dean Foods. It's the largest milk producer in the country. After a sharp drop in consumption, the company has a plan now to get people drinking it again. Jane Wells has more from City of Industry, California.
Remember this stuff? It's called milk. When's the last time you had a glass?
This is a category that really needs innovation and news.
Milk consumption has been falling for decades, at least cow's milk. Sales of plant-based milk, especially almond, are rising. Now the nation's largest milk producer is trying to move the trend back.
Okay, class, who can tell me if
Dean Foods has launched the first national milk brand called Dairy Pure. By combining milk from its more than 30 regional dairies under one brand, Dairy Pure automatically becomes a $2.5 billion brand, one of the largest consumer packaged goods lines in the country.
This is running about 100 jugs a minute.
Chief Commercial Officer Ralph Scazafava is helping to lead the change. Inside the Altadena dairy the company owns in California, he says in a unique twist, the company does not want to lose regional brand equity. So Dairy Pure labels will be co-branded with the local brands. It's a similar strategy the company did with True Moo chocolate milk, which is now #1.
That brand is a $700 million business for us, and it's on its way to $1 billion, and that's really our goal for it.
This is all happening as milk prices fall due to a glut. So Dean Foods is spending heavily to promote milk as a good source of protein and vitamin D without antibiotics and from cows that have had no artificial growth hormones.
This will be category-leading spending. It's probably the most that's been spent against fresh white milk in many, many years, if not ever.
I take it it's a 7-figure ad spend?
Yes, it is. Thanks for asking.
Scazafava says creating one national brand makes it easier for grocery stores by providing one barcode and the opportunity to partner with other national brands.
And I think cookies and milk's just so natural, it's unbelievable. So pick your favorite brand.
Have you reached out to that favorite brand?
I think the reaching out's gone back and forth, yes. So we're in process, so more to come. It'll be exciting.
The hope is to make milk something more than you pour on your cereal or in your coffee, to make milk cool. It's a big gamble.
Starts pure, stays pure, Dairy Pure. Like moo.
For Nightly Business Report, Jane Wells, City of Industry, California.
Earlier in the program, we heard from Warren Buffett himself at the annual gathering of Berkshire Hathaway shareholders, where he was surrounded by 40,000 people who wanted to hear him give advice, which he did. But this year, the questioning got a little bit more serious. And with us now is someone who's covered Mr. Buffett for years. She's senior special correspondent at Fortune magazine. She's NBR contributor. There she is. Susie Garib, welcome
She's
back.
back. Good
Nice to have you here.
Great to be here. What a weekend it was. You said 40,000. So it gets bigger and bigger every year.
What was different this year?
Well, first of all, it used to be when I first started doing this 10 years ago, mostly American investors, and now it's very international, a lot of Asians. There was a big Chinese delegation that came all the way to Omaha to meet with Warren Buffett. And, you know, the other thing is you used to have to own at least one share of Berkshire Hathaway stock to get into this meeting.
And
like
now?
an exclusive club. You can buy tickets. So it's just
Really?
a sign that it's gone very mainstream America. They all want to learn how to invest like Warren Buffett and, you know, and have fun doing it. So it's a good thing.
Yeah, the succession always comes up, and he's in his almost middle 80s now. So
85 in August.
That's fantastic.
He was amazing, high energy.
He always is, but what about the succession issue? Was it more serious this year or less serious?
I think, Sue, it's gotten to the point there they're not so worried about the actual name, who it is, but is this person going to preserve the culture, the corporate culture? You know, we have CEOs always talking about our culture, but in the case of Berkshire, it's about core values, about trust and ethics and lead by example. So they want someone who is going to preserve that culture. And presumably, they've got a lot to choose from. There are 80 CEOs of subsidiaries in Berkshire Hathaway. They all know the Buffett way, and so I think they'll probably come up with somebody who fits
These
the bill.
gatherings traditionally have been pretty adulatory toward Mr.
Yes,
Buffett.
it's a love fest.
But I gather this year that there were some questions that were very pointed, specifically with respect to his and Berkshire's relationship with 3G, a private equity investment firm, whose tactics, once they take over companies, can be pretty rough elbowed.
Right, and there were a lot of questions about 3G Capital, and you're right, they're more serious, they're tougher questions, more sophisticated. And the issue with 3G was they partnered with Buffett. They bought Heinz Ketchup, as you know, recently Kraft Foods, and when it came to Heinz Ketchup, they've laid off a lot of people. One shareholder, a woman, asked this question that, you know, are you moving away from aspiring to balance, her words, capitalism with compassion? Because the Buffett way is you buy a company, you let them do their own thing, very decentralized, but you don't go in and, you know, start chopping up the staff.
And you hold it for a long time,
And
too.
you hold it for a long time, and we're not sure about what the business principles of 3G are. So a lot of concern about that. Is it just making money, or is it making money and also building a company you're proud of?
Yeah. Susie, great to see you.
Good to see you.
Thanks for covering the event for us. We appreciate it.
When we come back, behind the scenes with the winner of the Kentucky Derby at the moment that American Pharoah won the race for the roses.
Meantime, Corinthian Colleges has filed for Chapter 11 protection. As we reported last week, the for-profit college closed its remaining 28 campuses, affecting 16,000 students. At its peak, the company operated 120 colleges with more than 110,000 students across the country.
Finally tonight, American Pharoah won the Kentucky Derby. On Friday's program, we introduced you to his owner, and on Saturday, our cameras were there when his horse crossed the finish line. Robert Frank has more.
The most exciting 2 minutes in sports was exactly that on Saturday. Kentucky Derby favorite American Pharoah did not disappoint the record-breaking crowds at Churchill Downs in the 141st Run for the Roses. The undefeated 3-year-old thoroughbred raced past his undefeated stablemate Dortmund in the final stretch and outpaced Firing Line by 1 length. It's the first time his owners, Ahmed and Justin Zayat, have ever won the race.
I still can't believe it, okay?
I feel like I'm dreaming right now, so don't wake me up.
Ever!
A big win for Zayat, who's been racing horses for 10 years. Before racing, Zayat owned the largest beverage company in the Middle East. The winners bring home the roses, the trophy, and $2 million in prize money.
Hopefully next trip is a Preakness.
Yeah, Baltimore.
American Pharoah is now the favorite in the Preakness in 2 weeks, the second leg of the Triple Crown. For Nightly Business Report, I'm Robert Frank.
And that's it for Nightly Business Report. I'm Sue Herrera.
And I'm Tyler Mathison. Thanks for joining us tonight. See you tomorrow.